Welcome back to the What's More podcast. I'm your host, Quinton Harris, and man, do we have an episode dialed in for you today at episode 188. My guest today is Mr. Logan Mohtashami. He's a renowned expert in the mortgage and housing ecosystem, recognized for his insightful analysis and commentary on the U.S. economy and real estate market. Mohtashami is a lead analyst for HousingWire and is a regular contributor on the HousingWire Daily Podcast. With a background spanning over 2 decades in the mortgage industry, Mohtashami, nicknamed the Chart Guy, has remarkable ability to decipher complex economic data and translate it into understandable, actionable insights. This knowledge has made him a sought-after commentary, and his expertise has been featured extensively in news outlets, including CNBC, where he's a frequent guest. I'd like to welcome to the show, Mr. Logan Mohtashami. So Logan, welcome to the show, man. We are excited to have you on here. When I was talking to you about coming on the show, we had quite a few things that we were talking about. And I mean, I feel like we have a lot of the same thoughts that align, but I have a certain section of my audience. I mean, these are the guys holding on for dear life to 2008. They're like, you know what? It's going to drop. What goes up must come down. I've heard it all. But I thought to myself, I got to bring the expert on the show, in my opinion, to debunk these 2008 naysayers. And Logan, I just can't thank you enough for being on the show. And, quickly here, we'll just get started. Why are we not going back to 2008? What's going on here?
So one of the things I've learned over the last few years while touring the country is that a lot of people have not studied like housing economics. And one of the things I've found out is that if we go back to 1942, there was only one time in history where prices actually crashed. Wasn't the late 70s, 80s, 60s, 70s. I mean, the only period in time was 2007 to 2011. In fact, it's very rare for nominal home prices to ever fall in America. We had one back-to-back years where we were flat in 1990 and when 1% decline. But when we talk about housing 2008, and a lot of the charts that I try to show is it mathematically can't be 2008 because of what qualified mortgage was. And qualified mortgage was the law that was created in 2010, which basically meant everyone had to have the capacity to, own the debt, really. You had to have the ability to pay. So what that did is it took all the exotic loan debt structures in America off the grid. So pretty much everyone has 30-year fixes. This also means you can't have a credit or sales boom like we did from 2002 to 2005. But the one thing I realized is that people didn't realize back then, bankruptcies and foreclosures were rising in 2005, 6, 7, and 8. Then the job loss recession happened. The loan to values were at very high levels, about 85%. And then we had this surge of new listings, especially from 2008 to 2011. All because we had so many distressed sellers. Now, how I try to explain housing economics is that most sellers are buyers, 70 to 80% of them. They sell their house to buy another one. 20 to 30% don't. Now, there's one group of people in America that buy a house that don't offer your house as a first-time home buyer. So this explains how inventory has been slowly falling for 14 years. Everyone's credit looks excellent. Like our family's been in banking since the late 1950s. We've never seen homeowners on paper look better because pretty much everyone has a 30-year fix, which means you have a fixed debt cost. Your wages rise, your housing cost, the debt cost becomes less and less each year. People live in their homes longer and longer. From 1985 to 2007, it was 5 to 7 years. From 2008 to 2024, it's 11 to 13 years, depending on who you listen to. It's in some parts of the country, 15 and 18 years. So you cannot have two dynamically different cycles in economics. Forget just housing. Than what you saw from, let's say, the run up in 2002 to 2011, from 2012 to 2024. And now we see it. I mean, it's 2024. We had the biggest crash in home sales ever in 2022. It's been the third calendar year of the lowest home sales ever recorded in history. And total active listings, we're going to use the NAR data. Traditionally, it's between 2 to 2.5 million going back 5 decades. 2007, it was 4 million. Today, 1.132 million. I mean, There's huge differences, like historical huge differences. And a lot of it is just the credit data. So it's impossible. You can't have the same credit cycle because the loans that were created back then that pushed sales and credit and everything do not exist today. So homeowners are sitting, most of them very comfortable, very low housing cost payments and living their lives. And they're not caught up into the crazy YouTube world of America that's talking about, I mean, I've done this for so long that I've actually kept a list of every single year since 2012, the reasons for a housing bubble crash. And it's year 13 now. And I mean, a broken clock has better economic game, but my job is to always show why, because, you know, when I present my charts to people, every time people go, oh my God, I never knew that. Oh, it's so obvious, right? So I think the presentation of the data and how you explain it really like changes everyone's mind that it's just not the same kind of marketplace. And we sit here in 2024, it shows itself. And I think a very key point for our data line is that in the last 4 years, new listings, these are the homes that come onto the market that don't get a contract. So from 2008 to 2012, it was running at 250,000 to 400,000 per week for 4 years. Here, the last 4 years, it's been running at 30 to 90,000. These are, if we had stressed sellers, it would show up there. 2023 was the lowest new listings data ever recorded in history. 2024 is going to be the second lowest ever recorded history because the majority of homeowners are doing well. And if most sellers are buyers, that pretty much means inventory has to stay stable unless you have some chaotic event, a job loss or something like that, that will force people to sell their houses in stress. And we don't have that in the data line yet.
Yeah, I always laugh because I ask myself this question, and maybe you could shed some light on it. You know, the people that are buying in or are part of the doom and gloom, I did like a little case study. I was at a restaurant and our waitress came up to us and I was having a debate with someone about this. And I was like, hey, can you add some light to this? And I said, I'm going to presume you're between the age of like 23 and 28, maybe 29. She said, yeah. I'm like, do you think the housing market's going to crash? And she goes, I mean, it has to, right? And I go, well, why does it have to? She was like, well, I mean, it just can't keep going up. And I was like, follow-up question, do you own a home? And she was like, no. And I go, well, do you think people that own a home think it's going to crash? And she was like, is this a psychology test or is this a debate test? And I was like, well, it bodes the point. I don't think people that own homes are going, yeah, it's going to crash. I think the people that are mad they don't own a home are the ones that are sitting back going, it's going to crash.
There's the renter dilemma of thinking, well, the only way I'm ever going to own a home is home prices are going to crash. And I always like to show the data from 1942. It is so rare to have nominal home prices fall, but 2007 to 2011, you actually saw stressed inventory. However, I always think of the housing crash people of the people that hate the Federal Reserve because I'm always arguing these guys, and these guys are literally born bearish, doom and gloom all the time. So you could have the renters that just assume that it has to, and then you have the Fed has inflated everything and we're on a verge of a crash every 7 seconds. So those two groups would actually, make sense.
Yeah. I always like to say, you know, they don't use, they're using fear over facts, not facts over fear. You know, they don't like it when someone like you or I actually bring chart data and examples out there. They just go crickets online when you challenge.
Oh, I slaughter these people in debates. They absolutely just slaughter them. I mean, I one of my things is I love challenging people, and it's just a slaughterhouse, because what I've realized is that if people don't forecast or have any working models, they just make up stuff.
Right.
And then you just ask them for their forecast and what their housing model is. They have nothing. And then you ask them, what's your 2024 forecast? So they don't say anything. So my rule of thumb is that you have to listen to people. If you're following forecasters, you have to listen to people who has at least forecasts for at least 5 years and can actually present their models. And, you know, you could look at their forecasts and see if they know what they're talking about. And, you know, they could explain their models very easily. And there's like less than 1/10 of the percent of the population world that do this. So
100%.
A majority of the people talking about housing aren't housing people. So they're speculators or spectators or homeowners or renters, but they're not data people.
Yeah, no, I couldn't agree more. So speaking of, you kind of led in my next question there with the Federal Reserve. Obviously I expected this to be a little quiet week. The economic front was pretty, we had one metric here on Thursday, but leading up until Monday and then Tuesday, it was kind of like a whirlwind. We got below the 3.7 on the 10-year. And I know the mortgage guys, we were like, rally, it's coming, here it is. And then, just boom, like that disappears and it's gone. What is your take on that? Was the market pricing in too much and then retreating, or was that a false positive?
So one of the things I do on Instagram stories, because I totally nerd out 24/7. I show people daily charts of the 10-year yield. Like my whole work is the 10-year yield, everything. So in this case, the 10-year yield has been slowly moving in a downtrend, which was positive. But then we had market forces that actually drove the 10-year yield excessively lower, which always happens at times. The bond market gets excessively overbought and oversold. So we look at the charts and I say, and just with my work, because a lot of my work revolves around 10 years, I said that 380 level should hold unless the labor market's breaking. It's not breaking just yet. So we saw a crazy volume the morning, got down to 3.66 and then just a reversal. And if you look at the downtrend on the 10-year, it's starting to get back to where it normally was. This happens from time to time. Whenever you have big volume buy days and sell days, they're usually kind of, short-term events, and then you get a quick reversal. And that's what we said. It actually looks pretty normal to me. Whereas sometimes when you have a lot of market stress, trades have to be unwound and money goes into the bond market, which is a safety trade. And that's kind of what we saw.
Yeah. Thanks for explaining that. Do you think where we're heading into September now? I mean, is it obviously, I think it's a foregone conclusion. Yes, a cut is coming. Do you think it's 50, or do you think, are you buying into the camp of, hey, it might be more 75 at this point?
I don't believe this Fed will do a 50 unless jobless claims data. And this is my take going back to 2022. I'm not a Fed pivot person until the labor market gets so weak that everyone starts screaming at them that they need to start cutting rates. Because to me, they needed cover for their rate cuts. So I always do this in my podcast, paper, rock, scissors. Labor data over inflation, right? They need softer labor data. So unless jobless claims start to really pick up higher, which, today the report came out and it was fine, they're probably going to do 25. This is a very, very, very slow Federal Reserve. And they're slow on purpose because they created their own kind of model in late 2022. And their model says you have to attack the labor supply. And they feel confident that if the labor market was breaking, they can do things to help the economy. But I would be shocked if it was 50, just because of how they've acted for the last 2 years. I mean, they were hiking rates after the Silicon Valley banking crisis, So this is one of these things that, they're sticking to their game plan. Once jobless claims start to shoot up higher, the whole narrative change. And just for real estate and mortgage people, that actually matters more than rate cuts because the 10-year yield will start going lower. Hopefully by that time, mortgage spreads get lower and you get easily sub 6% mortgage rates. Even you could have sub 5% mortgage rates in the scenario if we do actually have a job loss recession. So there's a lot of things that kept rates inflated higher that aren't normal in traditional cycles, but we're kind of getting toward the end of this. There's a lot of these labor data lines internally that I track with the Fed, and I know 2 of the Fed cities hate me because I know they follow my work and I always bash them on the podcast. But we're getting toward the end of their kind of, okay, they're going to stay as hawkish as possible. And when the labor data gets more softer, they'll be more dovish. But I think the 10-year yield will do most of the heavy lifting for them. And that's more important to real estate than the Fed funds rate.
Yeah, I know. I agree with you about the Federal Reserve. We've asked Bostic to be on our show multiple times, and it's like crickets chirping. And so definitely had a couple of questions for him. It was interesting. We got a chance to meet him a couple of months ago. And to your point, he was asked about a rate cut, and he, typical Fed answer, robot answer, 2% mandate target. But he did say that the only thing that could make them pivot would be essentially a change in the labor market. And he didn't say to what tune. He avoided that.
Yeah, that's so. I mean, Bostic actually made this comment, which is actually funny, because my thing is I have to show people the Fed isn't going to cut rates or pivot until the labor market breaks. This is a 2-year battle for me because everybody kept on saying they're going to cut rates. I was like, no, the labor data needs to get worse. But Bostic made a comment that He said, oh my God, if we cut rates 0.25%, do you know there could be massive business investment that could go off in animal spirits? They're at this stage, which half of this is storytelling, to the marketplace. But I've always said jobless claims is the key data line. It's only in the last, I would say 5 to 6 months that the Fed is openly saying that. They say, well, if the labor market gets weaker, we'll do more. We follow jobless claims. Jobless claims were heading lower. That was true back then. Now it's not the case. There are very big job openings, job openings, the quit ratios pre-COVID, hires are pre-COVID. So they're finally getting to the point where all their labor supply data are hitting to a level where they could feel more comfortable. But they're going to be unbelievably slow with the rate cuts, which means they're going to be restrictive, right? Even if the Fed had cut rates 3 times already, their policy is very restrictive based on where the Fed funds rate is and where the growth rate of inflation and wage growth is. And it's all by design. They ran this old model about attacking inflation, and it's really attacking the labor supply.
Do you think there's a chance that unemployment or the labor market is almost like a runaway train? It can get away from them before they can come back and correct it?
Usually, if that's the case, you see residential construction workers lose their jobs in manufacturing. And that's the one missing piece now that I actually track economic cycles first, housing second, but most people know me for housing. But if you look at every single recession going back decades, residential construction workers tend to lose their jobs first. These are single family construction, apartment building, and remodeling. And then the economy follows through. Until we see that, it's very hard for jobless claims to really take off in a short amount of time. So it'll kind of be a slow move up. But the unemployment rate, and this is one of the things we've at HousingWire try to get people ready for 6 months ago, because the labor force growth is growing. If jobs don't print like 250 to 500 or 250 to 300,000 per month, we could have the unemployment rate rise like for 12 months here. And we've gone from 3.5% to 4.3 without losing any jobs. And if you get more weakness, this thing could push faster on them. But once manufacturing and residential construction workers lose their jobs and industrial production falls and real wage, that's every recession we have seen post World War II. So I think they have their eye on the ball on this because they've been so tight for so long. But if jobless claims start rising on them, it doesn't matter what the Fed does. The 10-year yield will go lower and do a lot of their heavy lifting like they've done already. We've gone from 7.5% mortgage rates to as low as 6.34, and with no rate cuts because the market is trying to get ahead of the Fed like it usually does. And I think that's going to be the battle for not only the second half of 2024, but for 2025. When will they actually start to get more proactive? Because if they do slow cuts, they're just heading toward a neutral policy. Like if they cut 6 to 8 times, they're just neutral. They're not doing anything accommodative. This is why I tell people the Fed hasn't pivoted. They've done no cuts. And even if they cut 3 or 4 times, they're still very restrictive. So there'll be a point where they say, okay, the economy is in bad shape. We need to be more aggressive. By that time, the spreads with the mortgages are going to go lower like they have in every cycle, and the rates will go lower. And they're hoping that housing, because sales have been so depressed and because 5-unit permits are at recession lows and single family permits, they're hoping that housing, what it always does is lead the economy out of recession. So it's a dangerous game they're playing at this stage.
It feels like
I've been very vocal about that. It's like you have a layup. You've had a layup for like so long, and you just don't take it. But it's been my kind of policy with them is that they're not going to pivot until labor breaks, and they're going to be talking about keeping financial conditions as tight as possible until the very last second, and then they're going to go. But we're getting toward that. We're getting toward the end because their data lines that they track are getting softer on them.
So 2 questions on the labor side. So we've seen a recent indication survey from the Federal Reserve that says 17 of the 19 members got concerned when unemployment got above 4.1. And as you mentioned, we're at 4.3. So does that need to be the magic number? And you also continue to say continuing claims. Like, what does that number need to look like? What does that print need to look like?
The Fed actually forecasted a recession in 2023 because they had the unemployment rate at 4.5%, 4.6%, and the labor force growth wasn't going to grow that much to not have that be a recession. But I think what's occurred here now is that the job gains are becoming very condensed, which means the labor market is actually getting softer than they realize. Also, the job openings data it might be still elevated, but the quits ratio is pre-COVID, which means you can have continuing claims rise even faster, but they're so focused on jobless claims. And my kind of line in the sand, if jobless claims, 4-week moving average gets to 323,000, it's 242,000 right now. There's your job loss recession. That ties with every single cycle. So I think jobless claims will run the show. Powell's talked about it, other Fed presidents, because they see hiring being slowed down. And that's the first stage of going into recession. Then the next stage is the layoffs. So they could get smart and get ahead of the curve, but we're not there yet.
Yeah. A question for you. So if you were in front of Jerome Powell, you had a moment to talk with him, give him a piece of advice, what would you tell the man right now?
I would basically say you're playing with fire that you don't need to. The growth rate of inflation would have fallen down if you didn't do the last 6 rate hikes. The history of global pandemics, very inflationary. Then the disinflation happens. We don't have a booming wage growth 1970s economy or supply shocks from oil. So land the plane. There's nothing you're doing now that gives you an advantage for the next 2 years. Okay, so start getting more dovish. Get the long end of the bond market down. So the housing sector, which is the sector that takes you into a recession, is already on the cusp of that. Why risk it? There's nothing to gain here. Make sure that you could land the plane with that. And I would show all the charts and go, this is where you guys always mess up because you're always late. And you can do this. You don't have to worry. I mean, CPI inflation is at 3% headline. Going back to 1914, the average is 3.3%. So you're dancing with a ghost now. So just move it along and let the long end of the bond market do it. And you could cut rates and then get yourself to neutral as fast as possible. Because if you lose the labor market and you're going to have to do things faster. So there's no point in delaying. So, but I mean, that's kind of been my theme for them for some time. But just knowing them, they're going to wait till the very last second.
Yeah, they're actually going to go until they break something. Yeah, Feds and tourists are going until they break something. Do you feel like coming out of the last meeting that there was maybe there was an argument that took place behind closed doors or a heavy debate about what they did? Because it looked like a different kind of Fed coming out.
Definitely. First of all, Powell looked skittish. He looked very uncomfortable answering the labor questions. And part of that is I think that to me, that's what they've always wanted. They wanted the labor market to be so soft that people start saying, why aren't you cutting? Like if they had cut rates in the last meeting, nobody would have said anything really, because everybody is like, hey, listen, the unemployment rate's rising. But there's dialogue, of course. They were never going to wait until PCE hit 2% to start cutting. So we're at 2.5%. They're almost there. They're really focused on these month-to-month print now. Like we're going to have a very hard comps to get year-over-year data to fall. So these month-to-month are key. And then just move it to the next stage. And the faster they do it, the better, because they're only talking about getting to neutral.
Right.
Like if jobs start to break on them, they got to get off of neutral and figure out where it's going to be. And they don't need to risk that anymore. Like they're like 6 to 8 months behind. Just move it to the neutral stance. And unfortunately, if they didn't do they can't go back in time, but if they didn't do the last 6 rate hikes, we would have had the same inflation data today. They kind of went overboard with their old model and they just stuck with it, which I thought they would. But now it's a different stage. Now they need to and that's what my concern is, that they don't react fast enough when the labor market's breaking. So I'm hopefully everybody joins forces and just starts bashing them or, getting them to just be a little bit more responsible in the forward language of the economy if the labor market breaks on them.
Yeah, I heard the term though, fishing with dynamite is kind of what the Fed's doing right now. And once the well comes to the surface, and that may be the labor market, that's when the big problems arise there. So we'll see how that goes and where it goes from there. But a question for you on the 2008 front, kind of going back to that. What do you see going on right now? I'll tell you something that to me that looks a lot like 2008 is the consumer credit market. That looks a lot like 2008. And looking at those charts, and you look at the delinquencies, and you look at the the amount of credit being issued right now compared to then.
Here's the thing with consumer credit. Consumer credit always grows. We would be in a recession if consumer credit doesn't grow. So the $1.4 trillion, like adjusting to inflation, it's not actually a lot of consumer debt. But what we see in consumer credit is younger households that are renters that are in lower income are showing all the stress, pretty much. There's sectors of the economy that can have some stress into credit delinquencies, but a lot of the stress we see in the data are lower income, single household renters, and that's popping up now. Homeowners on the other side look fabulous. Like the FICO score data is unbelievable. And that's the difference, because back in 2005 to 8, foreclosures and bankruptcies were skyrocketing, all with the unemployment rate falling. Right. We had 4 years of an expansion with rising bankruptcies and foreclosures. There was a 2005 bankruptcy law that happened. Bankruptcies were so much higher in the early part of the century. And then the law changed that, where people couldn't just load up with credit card debt and just file for bankruptcy and let it go. So we're in a different stage. But I would say that renter households are having a much harder time than homeowner households. And again, over 40% of homes in America don't have a mortgage. The mortgage payment as a percentage of disposable incomes, even today, is near all-time lows. So it's a lot of people have not just very low rates, but they've stayed in their homes for so long that their total wages, their total incomes versus their housing costs is so low. So that to me is the big difference on the homeowner side. But we do see younger household renters having stress in the data.
Yeah, I saw today where buy now, pay later. People were using this to buy groceries. I actually saw this.
Yeah,
that was disturbing.
It's becoming more and more popular. The one thing about that system is that for a lot of lesser income people, it's not a lot of debt. They don't really give like really big balances or anything like that. Some of the people that have higher incomes can maybe get a little bit more credit availability, but they're kind of just limited. A lot of people thought we'd go into a recession in 2022 because of buy now, pay later, but the amount of credit they give is not a lot out there. So people are still confused, like, why hasn't that broken the market? Well, some of these things are like $700 credit limits, so they're just, doing very marginal things. But back in the housing cycle, man, cash outs, booms, credit boom. I mean, there was so much credit being given back then on exotic loan debt structures. And it's just that's the different side. But renters, younger households, lower incomes, they're the ones showing the stress. So I always say that the rental market in that sense would be a little bit more stressed than homeowners. I mean, 30, 60, 90, 120-day lates are near all-time lows. Whenever the next job loss recession happens, it's going to take minimum 9 to 18 months from the start of the first 30-day late to get that property into a foreclosure,
right? To
this foreclosure supply. So you're looking at 2026, 2027, depending on when the first job loss. And back then, people were filing for foreclosures years before the recession started. So 2 different cycles. But I always tell people that people have to focus on renters more than homeowners in this scenario.
Oh, that makes sense. I often wonder, like, on this lock-in effect that we're looking to experience right now, like, what do you think, in your opinion, like, what is it going to take to unlock some of this? I mean, we know 89% of mortgages are below 5% in America right now. Like, what starts to unlock the vault there? What is that?
So this is the funny thing. I'm actually not a mortgage rate lockdown person.
Okay, you don't believe
that? I don't believe it for this very thing. Over the last 24 months, tons of people have sold their low mortgage rates to buy a house. But people have been living in homes longer and longer. Even before mortgage rates got down to 3-4%, we didn't see much shift in the selling distribution data in the pre-COVID, even the 10 years before that. So what's happened is qualified mortgage basically means if you cannot qualify for your house, you're not listing your house anymore. Where in the previous, the start of the century, we saw sales booming and active inventory rising with it. So a lot of people are reminded of that market. Now it's not the case. I mean, literally, home prices escalated out of control. Rates are out of control. A lot of people just simply cannot qualify for the home they want to buy, and they've got a very low payment. So unless they had to move, they would. But we've seen people with very low mortgage rates sell their houses every single week. It's not a lot, but if you could afford to buy another property and you need to move, people with low mortgage rates have done it. But again, we have so many people with such low nominal rates that, people just live in their homes longer and longer. So the turnover of housing has changed, right? It's like people buy a house. Well, they're not going to move. They have they just bought a house. Why would they move?
Right.
They might be here for 11 to 15 years. And that's such a huge part of housing economics that rarely gets talked about, that people just don't move around as much as people think, and they kind of stay in their homes I've been in my home for over 20 years. Yeah. And it's just, when rates came down, here's our model. So whenever mortgage rates actually fall, inventory is flat to negative. Whenever higher rates come, inventory actually grows because the days on market grow, weakness in demand. So whenever rates fell, we didn't see anything different in the data lines of new listings or anything like that. The buyer-seller equilibrium has changed, where some of you guys remember there's something called a fax machine and a transbox, and that's how people used to do loans, and it used to take 30 to 45 days. We could get transactions done in 8 to 11 business days. So a lot of people sell their houses, buy another one, and they don't even show up in the inventory data. It's such a quick turnover. But you have to be able to afford to move. And I think there's just a lot of people who, even if they wanted to move, it's not because their mortgage rates are low. It's just because they can't qualify. But every single week, we see it in the mortgage data. People sell their low rates, buy another one. There's just not a lot of it. And that's one of the reasons why total active listings is, everybody makes a big deal about 2019 inventory. 2019 inventory was the 5-decade low before COVID. Not a lot of people remember that. And I was like, that's why I was so worried about years 2020 to 2024. It's like, if housing demand picks up, and that's been a big thing in my work, the household formation, ages 28 to 35 are going to be the biggest patch in history in this 5-year period. So if demand picks up, boy, there's a chance inventory could break to all-time lows, and that's what happened. Yeah. And it's very hard to get inventory back to normal. You really need higher rates and weakness in demand. And we all can see it. We're not anywhere close to the 5-decade average, and this is the 3rd calendar year of the lowest home sales ever.
Yeah, to your point, I've owned my home for 20 plus years as well. And, it kind of speaks to where I am. And it kind of also speaks to the fact that this inventory situation, why it's so suppressed, because you've got someone like myself. I'm like, well, where am I going to move? Like, well, where would I go to make this make sense?
Yeah. And people's housing costs are so low to their wages. Wages always rise. That's the thing about housing. Like, the best hedge against inflation on planet Earth was an American 30-year fixed mortgage, right? Your debt stays fixed. Your wages rise more in an inflationary period, but your debt costs stayed fixed. And then we had a wave of refinancing. A lot of people got 2.5% to 3.5% mortgage rates. So they've been living in their homes long as their wages are so much higher. And now their payment went down again. So first world problems. Homeowners are doing good, and when affordability gets a little bit better, you'll start to get more people moving. But also the downside to that is if mortgage demand picks up, it's hard for inventory to grow. So this is why I love 2024 rather than 2023. We are actually creating a buffer. Like, I was on CNBC just 2 weeks ago, and I said 2024 is great because we're creating a buffer with inventory, which we needed, because in 2020, 2021, 2022, 2023, if rates had gone down, it's hard for inventory to grow in that environment. This year, we're able to string out inventory growth. It's not back to 2019 levels, but it's good enough to create a buffer, and there's more choices out there for people, right? There's more product of homes out there for people to see. And these, to me, are all positives where it wasn't the case early. Like early on, I was like, there was these group of people, I call them the forbearance crash bros. It's a bunch of guys on YouTube who have no idea what forbearance is. And I was like, I'm more concerned about home prices escalating out of control than having a 20% forbearance crash. And it became a problem when, here, a good example is our inventory. It's a little bit different than the NAR. In March of 2022, we only had 240,000 single family homes available for sale across the country. For a country of 336 million right now, it's over 162 million people working. Too many people chasing too few homes. And we have to find, the only way to get out of that is with higher rates and let inventory grow. So this is why I think, I believe 2024 is a positive year. We've created a buffer. And when rates fall, we don't have this mad rush of, there's parts of the country, unfortunately, that don't have a lot of inventory growth. And there's other parts that do. But I always think of the areas that actually saw good inventory growth as a more healthier market than other places.
Yeah, I love that, because that's the first thing people turn to is like, oh, inventory's where they grab a headline, they don't dive deep, and they're like, wow, inventory's up 39%, or as if that's like a bad thing. To your point, inventory growth is a good thing. We need more options. We need the ability for sellers to sell and become buyers and have product to turn to.
You always have to be careful of using percentages working from historical lows. Like, the housing crash, people, look, your inventory data is up 40%. Home prices are going to crash. I said, homie, it's up like over 150% from the lows of 2022. So where's your 150% inventory growth crash now? So again, if I go back to 1942, the only time in history that we actually saw nominal home prices fall was 2007 and 2011. Monthly supply of homes were on average over 8 months for that period. Active inventory was so much higher, more. We had so many distressed sellers that couldn't be buyers, right? And that mechanism of flushed inventory, sellers being stressed, forced to sell and couldn't buy, facilitated the biggest nominal home price crash. And it's the only time in history this happened post 1942. So you have to have the same structural dynamics in place to have people willing to sell you their homes at 20, 30, and on a national basis, it's just not there. This is why home prices got back to all-time highs in 2023 and same case in 2024, even with record low levels of demand. The supply is actually just as low.
Yeah. And I mean, 100% to your point, it's going to be interesting to see what 25 holds, because it looks like we have all the makings and all the recipes to go up further in home price, even though people out there don't believe that. So, well, Logan, hey, thanks for being on the show today, man. I appreciate your time. For our audience, if you want to hear more insight, more details, charts, I cannot recommend Logan enough. Go check him out at the Housing Wire. Logan, any other places they can go find your information and your models out there?
So we have our weekly tracker, which is very popular. We give all the fresh inventory data for the country, we active listings, new listings, pending sales, price cut percentages. You can find that at HousingWire.com. We have a top 10 podcast, business podcast, Housing Wire Daily. Sarah Wheeler and myself go on twice a week, Thursday and Mondays. We do have a Housing Wire YouTube page now as well, so you could see me do my theatrics on there. If you really want to nerd out, Instagram, just my name, Logan Mohtashami. We nerd out 24/7. It's not a lot of fun, but if you like economic data, that's what I do. And if you want to see me just absolute crash or destroy the housing crash, people go on X or Twitter. I'm very well known for my breaking those people down in public.
Yeah, I'm not saying you're an antagonist. I'm just saying you're unapologetic. You're just
that's me.
Yeah, it's
to the point. Yeah.
I love it. I appreciate it. Thank you so much for being on the show, guys. Check out their podcast, Housing Wire. It's a fantastic podcast with him and Sarah Wheeler. You'll get all the information and breaking news and updates that are in the housing market. So, Logan, thanks again for being on the show. Greatly appreciate it.
Pleasure to be here.
Yeah, absolutely. Guys, if you like what you're hearing, please 5-star review this podcast. Leave us a note on there. Leave us a comment. Check us out on our YouTube channel at What's Your One More. All charts and information that we talk about will be on there as well for future shows. Thanks again for being on the show, Logan.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.